Hello everyone. My name is Anjani Kumar Khetan and I am based out of Bangalore. In this particular video, we will look at an emerging area of discussion among the preparers of financial statement is that when an entity is committing to net zero, okay, as part of its commitment to save environment, you know that ESG is nowadays has a lot of focus from from everyone, okay, from the regulators, from the investors, the analysts, and everybody is interested in ESG, and therefore, as part of its commitment, to the larger society in the world, when an company is committing to net zero, what are the implications on the financial reporting side? Do an entity which has made commitment for net zero, do that entity need to make provision also in the books of accounts? Do they need to make provision because they are committing themselves under IAS 37 or Ind AS 37 from the India's perspective? So this is what we are going to see in the current video in terms of how this entire thing has been addressed by the standard setters. Do you need to make a provision if you have such net zero commitments? So just to set the context, as I said, companies are making these days voluntary climate related commitments as part of the euphoria on the ESG. Accordingly, the issues are emerging on the financial reporting side, that once you make these commitments, do you need to make provision? If yes, what is the point in time you should make provision? And therefore, in particular, the key issue from a financial reporting perspective is, when does the liability of an entity arise which triggers recording of the liability or provision in the books of accounts? So consider a typical example, and in the next video, I will illustrate this with the help of a case study. Here I am only giving you some of the fact pattern which you should be aware what is the problem statement. So consider the scenario wherein in 20x1 an entity makes a public announcement for its net zero commitment, and as part of this the entity also lays out a detailed transition plan. It publishes a detailed transition plan. What it says, an entity envisages that because of this requirement, because of the net zero commitment, because it wants to be compliant with these requirement, entity wants a gradual reduction in its greenhouse gas emission. So for example, they are targeting that the reduction should be at least 70% by 20x8 year end. That could be one thought process. Now, to offset this remaining beyond 2008, so you are saying by 20x8 in this fact pattern, I will reduce my carbon emission by 70%. Now, any remaining annual emission 28 to 20x8 onwards in subsequent year, you will offset, the entity wants to offset by purchasing from the market the carbon credits and retire them. So use the carbon credits to fulfill your obligations under net zero. I mean, this is what is the scenario which we are portraying, that here there is a commitment, the public announcement which has been made by the entity to this effect. Now, to support this, what they do, they take further action. As I said, related to this is to support its public announcement which they made here. The entity has published a detailed transition plan, and this transition plan envisages, let us say, gradual modification of the manufacturing methods. How do they manufacture? The manufacturing methods need to undergo a change between this period and 20x8, which allows them to use, let's say, green energy, and therefore the reduction of 70% in the emission is likely to be achieved. So therefore, the entity intends to invest in more energy efficient processes so that you are more friendly to the environment. Okay, the entity may want to buy energy from renewable sources rather than, let's say, buying normal electricity from the electricity board, which perhaps creates which perhaps generates electricity through the fossil fuels. You want to use renewable source of energy, say wind power or solar energy. So the entity wants to buy energy from renewable sources and also want to replace some of the inputs which are, let's say, crude oil based or petroleum based. The inputs they want to replace by low carbon alternatives. So this is the plan which the entity has. They have made an announcement, and this is what the transition plan is. Right? Now, the entity of the management of the entity is confident by doing all of these, still their business would be profitable. The entity can make all these modifications and continue to sell its product at profit. So, by doing all of these, they will still be profitable in their business. Now, what happens? Starting to a 20x9, after this 70% reduction is achieved, what they want to do? They say that I will offset the remaining omission. If I have remaining emissions, I would offset by purchasing carbon credits and I'll retire them. And I will continue to make additional investment in green energy, property, plant, and equipment, which are environment friendly. The question has come from the preparers and the various stakeholders to the financial the standard setters is, in such scenario, do you need to make provision? Whether the entity needs to make provision under IAS 37 or under Ind AS 37 for such commitment which they have done, with the announcement which we have done, and there is a plan around it. Now, if you remember, if you try to recollect the provisioning requirement under Ind AS 37, now Ind AS 37 or IAS 37 says that there should be a present obligation. That present obligation could be legal or constructive. Plus, you should have a liability, right? Present liability, which is under which your outflow of resources will happen, and you will be able to measure those liabilities reliably. All of those parameters do exist. But in the context of these kind of announcement or commitments, do you need to apply and record provision under the Ind AS 37 or IAS 37? That's the question which have been raised by the preparers of financial statements. So what happens? The standard setter, under IASB, there's a committee called IFRS, interpretation committee, that has given a guidance as to when to recognize such liability. So the entity has said that the following two tests must be met to recognize the liability in relation to net zero commitment. There are two tests, and both the tests must be met. Thereby meaning that there must exist a constructive obligation triggered on account of the net zero commitment. So one question which you got to ask, that because of the net zero commitment, whether the entity has a constructive obligation. I'll detail that later. And if it does, then ask another question, whether the recognition criteria under Ind AS 37 or IAS 37, whether that is being met. If answer to both the question is yes and yes, then only there is a possible provisioning requirement. So what the guidance which IFRIC has given is that liability can be recognized for such commitments only when both these tests are met together. Right? Let's see. So, put differently, an entity will need to assess whether the net zero commitment which they have made, whether that creates a constructive obligation. If it does, then whether that constructive obligation meets the recognition criteria, which we are aware of under Ind AS 37 or IAS 37. If answer to both these questions is yes, you need to make provision. Another question is, when you are making provision, credit provision, what is debit? Should you debit expense or should you debit asset? So whether the entity needs to record an asset or an expense when provision is recognized. Even if these two conditions are met and you are recognizing provision, that's okay. Credit will be to the provision. What should be the debit? Should it be through expense or to an asset? These are the questions which have been raised by the various stakeholders, and This is something which we'll illustrate in the next video, but I'll give you the theoretical framework here to tell what decision points one need to get an answer on before making provision. Now, if, let us say, in a particular case, if an entity has made 3-4 commitments or 3-4 statements, 3-4 activities they want to achieve, one important guidance is that you do not have to look at the entire commitment as a group. Rather, you have to look at each group individually, assess each individual activity as part of the commitment, and then try to get to this test. So assess each individual activity which supports climate commitment and not the whole commitment. So when you are assessing, you got to assess individual parts. So how many subparts are there? Each subpart need to be evaluated for these two tests. Okay. So test 1, existence of constructive obligation of an entity. So therefore, for this test, at each reporting date, an entity needs to assess whether the public statement which has been made by the entity is sufficiently specific to create a constructive obligation. If yes, then it becomes test 1 gets met. So whether the entity has made public statement about climate commitment, if they have not made any statement, of course, there is no question of a liability or a contingent liability. But if they have, then the next question is, okay, they have made the commitment, public statement they have made, but whether that public statement creates a valid expectation in the minds of the people affected by those. And to evaluate that, you got to look at possibly factors like this. What is the nature of public statement? Have you made the detailed plan, or you have just made a generic statement of what you want to achieve? What is the method of communication? Have you communicated through your, let's say, sustainability report, annual report, or is it that you have gone to the Twitter and just made the communication? Formal versus informal communication. What is with what specificity and the status of the plans are? How much time it will take? Is it a long-term plan, short-term plan? Whether there are evidences available in the public domain of if you have committed that in 8 year, 10 year you will achieve something. During this period, what is your progress? Are there evidences which are there in public domain which people can look at? All of these factors you got to look at possibly, and if the answer to these is yes, that the public statement has created a valid expectation in the eyes of the people who are affected by it, then in that case your constructive obligation does exist, and then you have to go to step 2. Step 1 is met if answer to this question is yes, and this question is also yes. Okay, moving on to the next one. Yeah, so this we have seen that, of course, it is judgmental. Now, if you go to the next slide, whether when you are looking at test 2, whether the criteria to recognize the liability, we said the second test is whether the criteria is met. So, having determined that yes, the constructive obligation exists, you got to ask whether that public statement, it relates to the past damage done or is a future event. Because if it is for future events, obviously there is no obligation. There is no present obligation. But if it is for the past damage which you have done, then there does exist a present obligation. So for example, if you have done, let's say, contamination to a land in the past, and that you want to make good, then that contamination is your present obligation. So you got to ask whether this requirement, the statement which has been made, is it for the past damage done, thereby you have a present obligation, or it is for a future event. Now, depending upon what that answer is, if it is for future events, no liability or contingent liability exists. But if it is for a past damage done, then you have the second question to be asked, that yes, I have a present obligation arising out of past event. Whether an outflow of economic resources will happen, is that outflow of economic resource is probable, which is 50% more than 50% threshold, which is consistent with what you would have seen as part of the requirement in IAS 37 or Ind AS 37. So if the answer to this question is no, you do not have a probable outflow of economic resources, then in that case, there is no liability per se, but you may have to disclose contingent liability or this amount as contingent liability as is given in IAS 37 or Ind AS 37. But if the answer to question number 2 is yes, then you got to ask the third and the last question. Okay, the outflow of resources is going to be probable. Can you measure it reliably? If we know, then it will still continue to be under contingent liability. But if it is yes, so if the answer to all these 3 questions is yes, 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 then you got to recognize liability, provided step 1 was also met. That means constructive obligation was there. So if you have all of these conditions met, both the tests met 1 plus 2, then in that case, you have to provide for the liability. Now, I will, of course, this we know, cumulative conditions, which is there under Ind AS 37 or IAS 37, that you will make provision only when all these 3 criteria is met, that you have a present obligation arising out of past event, probable outflow of cash, which is there, or other economic resources, and you can estimate that reliably. Now, if you combine both the steps together, this chart shows you that. So first test is, you have to look at what is the constructive obligation. If the constructive obligation does exist, which means if the answer to this question and this question is yes and yes, then you move to step 2 and look for the steps which we saw in the previous slide. Thereby meaning that you have to first look at step 1. If the answer to these is no, obviously you don't have to make the provision, but the answer to these 2 is yes, yes, then you move to step 2 and look for the questions which we saw. Is it for past damage or future events? Past, if the answer to this is yes, then look for whether the outflow of resources is probable. Yes, it is probable. Then can you, the amount involved, can it be measured reliably? Yes, then you got to recognize liability. Else, not. And in the next video, I will take a case study and use this flowchart to explain in what circumstances one need to make provision and when it is not required to make provision. That's pretty much I wanted to cover in this particular video. Okay, so I will see you. As I mentioned in the earlier video as well, I hope you are liking these kind of a content. If you are, please do subscribe to my channel to support me and the channel, and also do comment in terms of whatever your inputs and feedback is. And then also, if anyone you know who might be in need of these kind of a content and is not aware, please share these videos, and that will be a great help for me. Okay, as well. Thank you very much, and thanks for your attention. I will see you in the next video when I will explain the case study related to this net zero commitment. Thank you. Bye for now. Take care.